Hello friends, welcome to our channel Accounts and Finance with FARSK. This is our video on the ninth part on the series on the financial accounting ratios, earnings ratio 2 of 3. Hope you will like, share and subscribe our channel. Earnings ratio 2 of 3. The 5 standard financial accounting ratios: liquidity, profitability, solvency, turnover, and earnings ratio. Introduction. Earnings ratios are also known as the market ratio or market value ratio. The market value ratio is a financial ratio that is used to determine the share price of a company's stock. Hence, the investor measures the market is compatible or not in relation to the company's stock, and also the pricing and issuing of the stocks in the open market, as these are concerned with the rate of return on investment for shareholders or stakeholders, and with the relationship between return and the value of an investment in company's share. Market value ratios are financial metrics that measure and analyze stock prices and compare market prices with those of competitors and against other facts and figures. These ratios track the financial performance of public companies to understand their position in the market. Through market value ratios, you can determine whether the stocks of a particular company are overvalued, undervalued, or rightly valued. You can also figure out the optimal prices at which the shares should be bought or sold. Other than evaluating the present share price of a public company's stock, these metrics also help existing and potential investors to make financial decisions about investing in shares. Various financial metrics control share prices in the stock market. For business owners as well as investors, these metrics are important to track so that they do not lose their money in wrong financial decisions. The types of earnings ratios: profit earnings ratio, earnings per share, payout ratio, cash flow ratio, price to sales ratio, PEG ratio, EV to EBITDA, and EV to sales. The first two ratios we have already discussed in our previous video, and now we will proceed to the balance of the earnings ratios. Payout ratio. The payout ratio is the percentage of net income that a company pays out as dividends to common shareholders. A payout ratio of 10% means for every dollar in net income, 10% is being paid out as a dividend. For instance, if a Microsoft earns $50 million in net income and the payout ratio is 25%, Microsoft will offer $12.5 million to all its common shareholders. Companies with low payout ratios. High growth companies often have low payout ratios. They use the money to invest in other projects. Companies that do not have positive cash flow or positive earnings. Companies with high payout ratios. Value-oriented companies where the board and management may own stock and pay dividends to themselves, where management is favorable to shareholders, companies that have a consistent dividend stock policy, companies that do not have any investment projects that are worth pursuing. Formula: total dividends by net income. Cash flow ratio, also known as price to cash flow ratio, is a stock valuation indicator or multiple that measures the value of a stock's price relative to its operating cash flow per share. The ratio uses operating cash flow, that is OCF, which adds back non-cash expenses such as depreciation and amortization to net income. P2CF is especially useful for valuing stocks that have positive cash flow but are not profitable because of large non-cash charges. Formula: market price per share divided by present value of cash flow per share. Price to sales ratio and PEG ratio. Price to sales ratio. The price to sales ratio, also known as the P/S ratio, is a formula used to measure the total value that investors place on the company in comparison to the total revenue generated by the business. It is calculated by dividing the share price by the sales per share. The P/S ratio was developed by stock market expert Kenneth L. Fisher. Fisher noticed that when a company experiences a period of early growth, investors place an unrealistic valuation on the company. When the value of the company drops below their expectations, the investors panic and sell the stock. Fisher believed that the company with strong management should be able to identify, solve the problems, and move on. If they can address the situation, the company's share price and earnings will rise. Formula: market capitalization divided by annual revenue. Well, that's it for today. Hope you like our video. For more videos, please do not forget to like, share, and subscribe our channel, Accounts and Finance with FARSK. Thank you. Have a great day.